watching Business Incorporated live from Channels HQ. Coming up, the South African rand strengthens by more than 2% against the US dollar. Ghana surprises investors by suspending some debt payments. Zimbabwe proposes incentives for $1 billion solar projects. Great to have you join us. I'm Laddie Williams. Let's kick off now with the market starting on the African continent. There we see sentiment that's mostly negative there. We see just the NGX in the green, up 0.04%, marginally up, showing that bullish sentiment continuing there in the local bourse there, Nigeria. South Africa's index still down from yesterday at intraday, 1.05%. Flip over to North Africa, we see the EGX30 there, that's also down about 0.32%, same as yesterday, same time. And we see Kenya there closing positive yesterday. Let's move over to the Middle East now. We see sentiment in the Middle East mostly positive right there. Abu Dhabi there and the UAE, that's down 0.28%. Dubai index up 0.20%. To flip over to other parts we track in the Middle East, talking about Saudi Arabia and Qatar, there we see Saudi Arabia, that's up about 0.07%, and the Qatari index, that's down 0.20%. Moving on to Europe now, we see EU members have finally agreed to a long-debated price cap on natural gas. They say will help households and businesses get through the winter. The plan puts an initial cap of 180 euros per megawatt hour on exchange-traded gas. Let's talk more now to DW Stephen Beersley, join us from Berlin. Great to have you, Stephen. So how is this cap supposed to help Europeans?
Well, essentially, this is the idea of a buyer's cartel, and that is the idea that buyers are going to flex their muscle a little bit and try and force sellers to come down with their prices to meet this artificial ceiling. Now, for the EU, you have significant heft amongst 27 nations who are all big gas customers. The idea is that their clout together will help achieve just this. Now, let's look at the background here. Gas prices have actually been high even before the war began. They were already rising because of global demand alone. Then the war in Ukraine drove them further up as EU nations tried to reduce the amount of Russian gas that they were importing, or Russia reduced it for them. And as they searched, they scoured markets essentially for other gas, especially liquefied natural gas, to fill up their reserves in the case of Germany and prepare for a winter in which they wouldn't have that steady pipeline gas from Russia. Now, so many of those costs for buying on the market, the costs have gone up dramatically. We should mention market prices have reaching 350 euros per megawatt in August. They've since come down, but those price overruns have then been forced to be passed on to customers, to businesses, to households, and that's been very difficult across Europe here, affecting the economy at a time when a downturn was already showing itself to be in the making. So what this rule essentially does is that as of mid-February, it forces European countries to join together to make gas purchases, again, to reinforce that clout that they have, and then it sets an initial deadline, initial ceiling of 180 euros a megawatt hour for gas purchases. But advocates point out that is a dynamic cap that can also move upwards if it needs to, based on reference points in the market for how the market itself is shaping up, the global market and not just the European market.
All right, Stephen, but I know some EU countries were against this. Why was it so hard to find an agreement for a cap?
Yeah, there were two things at work here. Essentially, there was a lot of questions about whether this was even something that would work. The other is that nations have different degrees of financial firepower to cover these price overruns. Now, Germany and some other nations said, look, we don't even believe that it's really up to a buyer's cartel to force prices here. Natural gas is a seller's market right now due to global demand especially, and that's only going to increase in the years ahead. Italy and other nations have said, look, we want this price to be even lower than it was at the beginning of discussions in in March. And so these were two cross currents here. But also keep in mind that Germany and Italy are also very different when you look at their financial firepower. Germany has already devoted a tremendous amount of money to alleviating the pain of gas overruns for businesses and for households with its deep pockets that, frankly, other nations can't really match up to. So there's been a lot of criticism that Germany has faced because of its ability to pay and then its unwillingness to go along with this price cap. But again, it says this is about security of supply. What came out of all of this was essentially a sort of a wobbly compromise that many people say has more holes than it does actually sort of create a cap. And that is that it requires, for example, the price to be at more than 180 euros for 3 consecutive days. And then it also has to be 35 euros higher, at least, than a reference point for liquefied natural gas on global markets. That reference price still has to be formulated, exactly how that's going to be calculated. Outside of that, there are other exceptions. It only applies to exchanges, not between deals between buyers and sellers directly. The cap will also be set aside if nations deem that there are security threats to supply. So there are plenty of ways to get out of this if necessary. And that's why some critics point to it and say it's not really that strong.
All right, so much to unpack there with the gas cap. But what do we expect from European markets today?
When European markets began the day by falling initially, all down around half a percentage point. When you look at Frankfurt, when you look at Paris and London, basically the biggest impact so far on the day has been news out of Asia, and particularly out of Japan, that the Bank of Japan is making it easier to raise interest rates in the coming year. They've loosened the spectrum of interest rate hikes that they can make, and that's basically a signal that they're about to start to curtail their ultra-loose monetary policy that they've had in recent years, and markets are taking that as another sign that everyone is bracing for recession, and investors are acting accordingly. Otherwise, European markets here will be especially tuned into a consumer confidence report later in the day that could also move markets right as they approach close.
All right, all eyes on Bank of Japan now. Thank you so much. That was Stephen Beardsley right there in Berlin. Thank you. Moving on to other markets now. We see stock futures slipped whipsawing after an announcement from the Bank of Japan. As traders fear a yen rally may not come to fruition. Futures tied to the Dow Jones Industrial Average were down this morning. They're about 0.1%, having earlier been down more than 200 points. The S&P 500 futures and NASDAQ 100 futures there fell about 0.2% and 0.4% respectively. The Dow on Monday shed more than 162 points. The S&P 500 fell 0.9% and the NASDAQ Composite lost nearly 1.5%. Stocks on track to end the month and the year in the red, and investors hope for a Santa Claus rally actually fading fast. Moving on to Asia now. Markets in Asia Pacific fell as Bank of Japan modified its yield curve, control tolerance range, while holding its ultra-low benchmark interest rate steady. The Nikkei 225 there fell about 2.46% to 26,568 points, leading losses in the region. And the Topix index fell 1.54% to 1,905 points. The Japanese yen strengthened by more than 3% against the US dollar to 132.56 Japanese yen, marking its strongest levels in over 3 months. In South Korea, the Kospi fell 0.8% to 2,333 points, and the S&P ASX 200 in Australia also traded 1.54% lower to close at 7,024 points. All right, now for commodities market update, we see that instant noodles have become an important staple in Nigeria, consumed practically in all urban households, alongside other consumer staples like spaghettis, and consumption of instant noodles in Nigeria has increased slowly but steadily over the years. The global instant noodle market is projected to grow from $54.60 billion in 2022 to $81.84 billion by 2029. And now let's hear more now from Miriam O'Day, analyst at Financial Derivatives Company. Great to have you on the program. Miriam, what factors are responsible for the increased acceptance of instant noodles by both the Nigerian and global markets?
Good afternoon, Ladi. In the Nigerian and the global market, instant noodles has become one of the staple foods because of three major reasons. One, its availability, its convenience, how convenient it is to make make noodles, and its affordability. If we look at the Nigerian government, noodles currently stands at on an average, the price of noodles is 80 naira to 120 naira, and the minimum wage is 30,000 naira. So we can see that an average Nigerian can consume Indomie at least once every day and would still have enough disposable income to spend on other expenses. Then, based on convenience, it is one of the fastest foods to be cooked, and especially in Lagos when there's traffic, is once you get home, all that's running through your head is eat and sleep. Indomie or noodles is the best bet. In the global market, the new modern work style, which is where both parents go to work and leave the kids at home. What is the hope for these children when it's time to eat, or what do they do when it's time to eat? The best bet again is noodles, because it's easier and it's simple to cook. So these are the reasons why noodles is is having an increase in demand both in the Nigerian and the global market.
Yeah, obviously we know the kids do love the noodles a lot, but we've seen the price of durum wheat is really about 50% in Nigeria, and obviously this price increase is also, translated to noodles. Do you think there'll be some kind of fall in demand going forward?
If there's a fall in the demand for noodles, it's going to be insignificant or substantially small. It's not going to make a substantial impact in the it's not going to have the increase in price of noodles is not going to have a substantial impact on the demand for noodles. We can see this if we look from the angle of inflation rate. The MBS has recently released a report that inflation rose to 21.47% in November, and in the noodles industry, we have 16 different brands that are producing noodles, but obviously all of them are not producing at the same quality. So instead of seeing a fall in the total demand for noodles, we expect that consumers would downgrade to cheaper alternatives, like cheaper noodles, instead of going for the more expensive or the noodles with higher quality. They would rather purchase noodles with lower qualities and cheaper price. Also, if we look at the growth of supermarkets' growth rate is at an annual of 3%, meaning that supermarkets would grow steadily in 2023 by 3%. With the growth of supermarkets with the increasing presence of supermarkets in the country, we can expect that Indomie noodles would become more available to the layman, and this could also support the demand for noodles.
Right, I know that brand name is so synonymous with noodles. Anyway, thank you so much. That was Miriam Ode, analyst, financial derivatives company. Thank you so much.
Thank you.
All right, let's look at other commodities now. We see oil prices rose, supported by a softer dollar and a U.S. plan to restock petroleum reserves, but gains were capped by uncertainty over the impact of rising COVID-19 cases and top oil import to China. Brent crude futures were up 50 cents at $80.30 a barrel in early trade, adding to a 76-cent gain in the previous session. U.S. West Texas Intermediate crude rose $1 to 1.31%, about $76.19, after climbing 90 cents on Monday. Oil prices have been buoyed by U.S. plans to announce last week to buy up to 3 million barrels of oil for the Strategic Petroleum Reserve after this year's record release of 180 million barrels. And gold prices jumped 1% to above the key $1,800 level today as the dollar dropped after the Bank of Japan as a surprise policy tweak, while markets are also weighed the outlook for U.S. Federal Reserve's interest rate strategy. Spot gold rose 1.1% to $1,806 per ounce. The U.S. gold futures gained 1% to $1,816,000, lifting bullion's appeal among overseas investors. The dollar index eased on the day as the yen soared after the Bank of Japan decided to review its yield curve control policy. I will take a break now. When we come back, we head on to Ghana, see what's happening there as they've agreed to not pay some investors. That's our next conversation. Stay with us. Welcome back. Now to our next conversation. We see the Ghanaian government suspended repayments of debt service under certain categories of its external debt to reserve the country's depleting international reserves. Now let's talk to Courage Boti, economist and research lead at GCB Capital Limited. Great to have you on the program.
My pleasure. Good afternoon to your listeners.
So, Courage, what exactly does this suspension entail? Does it include both, external and domestic debt?
Well, for starters, the government announced domestic debt restructuring program some 2 weeks ago, I think on the 5th of December. And I think indicated at the time that the details of external debt restructuring was going to come. I must say this is not exactly external debt restructuring, but a news to suspend debt service on external debt. So this suspension does not include domestic debt. Domestic debts that fall due between now till the end of the offer period for exchange, which is 30th of December, will still be earned and interest to be paid on them. But for external debt, effective yesterday, no coupon payment expected until further notice, really. And that is where we are. So it excludes domestic debt at this point. It's all external debt and interest payment suspended until further notice.
Quite interesting. But how will this impact the Ghanaian economy and their rep in the debt market?
Well, I've seen the statement from the creditor committee for the external debt holders really trying to say they are willing to negotiate with government in a fair manner, in the spirit of burden share, to try to help the government restore some debt sustainability and all of that. To that extent, it appears the market, rather surprisingly, seem to be aligned and want to do their bit to help out. Domestically, our reserves are very weak levels. I think the last print was 6.5 billion, about less than 3 months of import cover, and the net reserve even much lower. With all of what is happening and the fact that we might not be getting FX inflows anytime soon from any external bond issuance and all of that, we might have problems servicing our debt going into the next year, really. Already growth is slowing down. Of course, we are kind of recovered a bit from the exchange rate problem we've had in times past. But of course, we are not out of the woods yet. And the agitation on the local market about the exchange program, which no one has seen whether we are going to be successful with it or not, because the negotiations are still ongoing. All of that leaves the IMF program in a balance, really, because we need to fulfill two conditions precedent to secure board level approval for the program. One of those is the domestic debt, and the other is financing assurances from our development partners. That second bit could be achieved because it wouldn't take much, especially when we have some goodwill with these financiers. But the main one, which is domestic debt exchange, seems to be a big challenge now because there are agitations. I've heard strikes announced from some labor unions and all of that. So it's still up there to be concluded, really. And if you do not see that through, continuing on your debt obligations to the external market in the next year without an IMF program would be a challenge. And I believe that is why they have suspended this. The immediate consequences might be that for the next few years, we might be locked out of the international capital market. The government is talking 2 years, but it could be more, depending on when the nature of debt restructuring that is being envisaged. But what is happening now technically represents a default on the side of government.
Yeah, definitely smells like a default at this time. But we've seen that the cedi has rallied in a couple of days, against the dollar. With all of this, what's happening now, do you see this rally, continuing?
in the last few days, say 3-4 days, it's been some stability, really. And so it tells you the wild run of appreciation is kind of over. I think it's motivated by the staff level agreement. It's motivated by the CD stabilizing around 50 and the speculators taking their profits. And of course, some interventions from the Bank of Ghana. But this run will not continue forever. And already it appears we are at a stable point. The hope is that if we succeed in getting a board level approval, what that does is it unlock other sources of financing, concessional financing for the 2023 fiscal year. We're looking at a deficit size of about 61 billion cedis, and to be financed entirely from external financing or concessional financing. So that will be a big boost to our reserve. And if you add that to the fact that conversations are ongoing about swapping some gold for oil, the success of that, I mean, no one can tell at this point, but it remains a prospect, plus the interventions on the market. If we succeed to or are able to push that through, plus balance of payments of from the IMF, chances are that we could have some fundamental support for the CD into 2023, especially given that the Bank of Ghana has suspended dividend payment for the banks locally. That alone would take out some repatriation pressures on the reserves, I mean, into 2023, and so we could have some stability going forward. But it's a fluid situation; it changes every day, and probably the next news could actually change the direction. But as things stand now, it looks like we've reached a stable point or stability point for the city.
Right, the direction really does change fast. But another issue now is that hot inflation data we got there, over 50%. What do you think the Bank of Ghana, what do you think they have in their arsenal to bring down, inflation at this point going into 2023?
Well, what they've done so far, as we see, is to tighten the policy rate, and in their view, it is to control the second round of inflation. In fact, the impact hasn't been instantaneous. We haven't seen much of it beyond the trend we've seen in April, May, June, where the month-on-month inflation curve started slowing down. But you would understand that the causes of the inflation are kind of varied. The main triggers, exchange rate depreciation, fuel prices, those two main drivers seem to be behaving well now, especially, of course, for the period September, October, November, when you saw very significant depreciation of the CD. It is actually the reason you will see that kind of jump, magnitude of jump, as we saw in November. But now there is a sharp correction. Year-to-date depreciation is looking like 23%. And then, of course, we've seen also that result in decline in fuel price at the pump, because the pricing of fuel in Ghana is determined mainly by the margins, the exchange rate, and of course, the international price of crude oil. And so crude oil prices are falling on the world market. Exchange rate is strengthening or has strengthened, and the margins are the same, really. And so those two key components would actually filter into inflation going forward. Not enough to bring any drastic reduction, but maybe slow the rate of increase. January policy meeting most likely will consider another rate hike in light of the significant jump we saw in November. But I guess we are approaching the end of the inflation cycle. The simulations I'm doing suggest we will peak maybe in February or March, and thereafter there could be a decline, really. So we are almost at the tip of inflation.
All right, everyone's still battling inflation, hoping for that peak, at some point. Thank you so much, Courage Boti, economist and research lead at GCB Capital Limited. Thank you.
My pleasure.
All right, now let's look at other stories now. See the South African rand strengthened by more than 2% against the dollar after Cyril Ramaphosa won re-election as the African National Congress president. The rand's fate has been inextricably tied to the president over the last few weeks after a report on the Fala scandal in late November threw markets into a spin for an uncertain amount whether or not Ramaphosa would stick it out as in his position. The rand also strengthened by more than 1% against the pound and the euro. And Zimbabwe has proposed incentives to accelerate 1,000 megawatts of privately owned solar energy projects worth about $1 billion. That's according to Finance Minister, as the country is scrambling to plug an electricity deficit that it threatens to compound its economic woes. The Southern African country is currently generating about a third of its 2,000 megawatts peak power demand and experiencing up to 18 hours of power outages daily after its main Kariba hydropower plant cut electricity generation due to low water levels. The finance minister says the guarantees would cover 27 solar power projects with sizes ranging from 5 megawatts to 100 megawatts and a cumulative capacity of 998 megawatts at a cost of $1 billion. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.